Any of the others, hard landing, soft landing. Remember, soft landing is still a recession. It's just a milder one, but it's still a recession. And recessions tend to be good for gold. That's actually a very strong correlate. Recessions, gold likes recessions. Sorry, but it makes perfect sense. It's a safe haven asset. So of the four, three of them are recessionary scenarios, and those are all bullish for gold. The no landing scenario is not bullish for gold as a safe haven. As a commodity, however, the no landing scenario is bullish for commodities, and that could be bullish for gold. Not a promise here, but it could be.
In the world of investments, gold has long been viewed as a safe haven during times of economic uncertainty. Lobo Tiggre, a renowned author and publisher of the independentspeculator.com, sheds light on the favorable relationship between gold and recessions, explicitly highlighting the positive performance of gold during soft landings akin to a recession. Financial markets have been buzzing with speculations about an impending U.S. recession, and Tiggre points out historical data that supports gold's outperformance during economic downturns. In 6 of the last 8 recessions, gold has outshone the S&P 500 by an impressive average of 37%. During a recent period from March 8th to April 24th, gold rallied over 9%, surpassing the S&P 500, which recorded just over a 3% increase. The influence of global economic players, especially China, further reinforces Tiggre's insights. When the citizens of economically significant countries like China feel affluent, they tend to invest in gold, contributing to its demand. Tiggre also notes that central banks, mainly those not aligned with the Western Bloc, may find gold an attractive hedge against potential issues with the US dollar. China, the world's top buyer of physical gold, continues to play a pivotal role in rallying global spot gold prices, reaching all-time highs. Reported global central bank gold reserves, via the IMF and publicly available sources, rose by a net 44 tons in November. Gross purchases, 60 tons heavily outweighed gross sales, 15 tons as central bank demand maintained momentum. Global geopolitical tensions add another layer to the demand for gold. Tiggre emphasizes that ongoing conflicts globally create a heightened demand for safe assets, positioning gold as a sought-after choice regardless of the economic landscape. Recent turmoil in the Middle East, marked by U.S. and British military actions in Yemen, triggered renewed interest in gold as investors seek portfolio insurance. Before you watch LoboTiggre's interview, subscribe to our channel and give this video a big thumbs up.
The wealth effect, particularly in BRICS countries or the emerging markets, that is bullish for gold. When the Chinese feel wealthy and they have money to save, they buy gold. That's their culture. We don't have to talk them into that or tell them how wonderful gold is. That's their natural, if not instinct, proclivity, let's say. And then you also have the central banks and the de-dollarization that we've talked to, and the concern they now have about maybe hedging their bets, if only a little, against something dramatic happening to the dollar or their access to dollars. That's something that has, even if there's no landing, right? And even if there's an economic boom, the central banks of the world, especially the ones that are in opposition to the Western Bloc, or at least to the United States, they're not going to say, oh, okay, we're fine with the Fed controlling our financial future. We're fine with New York channeling all our funds through the SWIFT system. That's not going to happen. So even in that no landing scenario, I don't see it making gold tank. I mean, we're not going back to $1,000 or whatever. I can see weakness, but I don't see gold cratering even in that scenario. And also, don't forget, we also have geopolitical risk. So you could say, okay, economic boom again, and there's less safe haven demand on the financial front. We're in a world where there are 2 hot wars right now, either of which could turn into World War III. I'm just saying that card is not off the table. This is not a world where people feel, hunky-dory, everything's fine, everything's perfectly safe. This is a world where you can wake up and, thousands of people have been bombed or massacred and kidnapped or whatever. It's the kind of world that is supportive for safe haven assets, regardless of the economic outcome. So I guess the short version is, don't get myopic about just this landing scenario and how that can impact commodities. There's a bigger picture here in the world. Last year, my highest conviction trade was uranium. This year, my highest conviction trade is gold. But the gold stocks are still on sale. Like gold itself is still over $2,000. We've been flirting with new all-time nominal highs. But the gold stocks, people hate them. in dollar terms, many of them are on the low end of their 52-week ranges. In gold terms, if you price them in gold, which is not only a real price, it's directly relevant in terms of what it is that they're doing, the nature of that business. In a gold business, you price the gold stocks in gold, and they're at or near like historic lows, all-time lows. And that is an opportunity, in my view. I mean, it's one thing for a gold bug to say, "Oh, I'm bullish on gold, yeah, hey, woohoo." But to be in that scenario when you actually have access to bargains still on the table. This is one reason why I like uranium so much a year ago. The writing was on the wall, uranium was already heading up, but it had gone sideways for a while and people were sick of it. They hated it. There were memes on the internet of uranium just lying there, not doing anything, right? And people hated the uranium stocks. People, especially people who chased them in 2021, when that previous spike, a lot of those, when the first excitement came in, a lot of people chased those stocks. Many of those people are still underwater. But last year, people just hated these stocks, but the price was going up. And so I got very excited and I made a lot of money for myself and my readers on uranium stocks. I feel this way about gold. I mean, for all the reasons you and I have been discussing, of course, I can be wrong. But if I'm right, we're already at $2,000 for years, more or less, on average, going into a bullish gold environment. Just 10% up from here is 2,200, which is way above previous highs. A 20% gain, $2,400, that would have people in the mainstream just like paying attention, I think. That's just a 20% increase from here. So possibility, not certainty, but that possibility at a time where you can still buy great gold stocks on sale. I just see it as a highly asymmetric risk reward proposition right now.
LoboTiggre highlights a noticeable change in the Federal Reserve's approach under the leadership of Chairman Powell. This shift, marked by hints of potential interest rate cuts, stirred significant reactions in the financial markets. The altered stance was reflected in Powell's statements and echoed in the dot plot, indicating a collective sentiment among Fed officials. However, fresh data revealing an uptick in inflation during December has introduced a twist in the narrative. The Consumer Price Index rose by 0.3%, exceeding the 0.1% increase in November. Furthermore, consumer prices climbed by 3.4% year over year, surpassing the 3.2% forecast by economists polled by Reuters. This data suggests that Fed policymakers might not be as eager to implement interest rate cuts as initially anticipated, particularly in the upcoming March meeting. Acknowledging the complexities faced by the Fed, Tiggre emphasizes the delicate position they find themselves in. On one hand, the Fed aims to avoid being remembered as the cause of economic problems. On the other hand, they strive to prevent widespread job losses and the associated misery of economic downturns. U.S. Federal Reserve Chair Jerome Powell has indicated a cautious approach, suggesting that there is no rush to increase the benchmark interest rate further. Powell cites evidence that inflationary pressures are gradually easing. He points out that the Fed is navigating nearly equal risks. Raising the benchmark rate too high could derail the economy, while not raising it enough might allow inflation to persist or worsen. Let's get back to the interview.
Despite what they say, they actually are not entirely stupid. They do see many of the same indicators I'm looking at, and they didn't want to overdo it. They have this difficult position. Poor Powell, I think he's flat out lying when he says he loves his job. Imagine having to be stuck between being remembered as the next Arthur Burns, killing the economy and pilloried for destroying unnecessarily jobs and creating widespread misery. It's not an enviable position. I don't see how you sleep at night because I don't think there actually is a solution to this problem that does not cause one or the other. But if I'm right, and if the data is as compelling as I say, and they're not entirely blind and stupid, then I can see them wanting to pull back. And again, remember, the markets went nuts with the 75 basis point cuts projected for this year, for 2024. And the market rates are equivalent to like 6 cuts and soon, like March. And the Fed never said that. So the Powell pivot here wasn't like 2018. It was a change, and it was backed up by his colleagues on the dot plot. So it's not just Powell. And, the most significant, ironically, is the mushiest part. It was less than the dot plot. It was Powell's conference afterwards when the reporters there feeding their milquetoast pre-approved questions about, well, gee, doesn't this indicate a bit of softening and so on? He did not push back and say, no, we're fighting to 2%. I mean, he did cling to the target, but he didn't do his usual Powell thing of, or rate hikes are definitely on the table and we'll do what's necessary, blah, blah, blah. So that was a change. And that's, I think, why the market's overreacted. I'm not sure if I've answered your question here, Tom. I've lost the thread. But I guess what I'm saying is the Fed's, I just don't think you get there by being entirely stupid. Like we disagree with them, or they can't tell you the truth so that they look stupid. Like if Powell comes out and says, wow, the shit is really hitting the fan. Can I say that on your show? Sorry.
Yeah, that's all
but if he says that, he will cause the very problem. He literally cannot tell the truth if it's bad. So you look at the stupid things they say and it looks like he's stupid or he's blind. He doesn't see anything. I just don't think that's true. I think, don't forget this guy was appointed by a Republican. They think that they are the managers of the ship of the economy and they have to steer it well. And they're trying to do their best, or they think they're trying to do their best to minimize damage and, bring the ship home. Nowhere in that mission does it say telling the truth. And so
it's a great point.
I mean, I don't think that's hyperbole. I think that's just the observable fact. Yeah, I mean, has the Fed really shifted? I think they're famous for floating trial balloons. And it's no sooner did they have this, FOMC press release and Powell's soft talk and so on, and then the markets overreact. So what do? Instantly, Fed speak turns very hawkish, and everybody else, everybody that came after that was talking, oh yeah, rate hikes are still on the table. Of course they're still on the table. Anything's on the table. They're data dependent. Rate cuts are on the table too. None of this means anything. It's all about trying to, massage and manage the economy with the jawbone. And, it's
maybe
kind of pathetic and disgusting to a hard-minded, numbers-oriented person. But, that's the world we live in right now.
According to HSBC economists, gold might stay below $2,000 in 2024 due to various challenges. Even though gold prices recently reached a new high because of global tensions, HSBC experts doubt it can stay consistently above $2,000. While may not drop significantly, but it's uncertain if it will maintain the record-breaking level. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. We aim to reach 5,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.